Hello everyone. I wanted to make a quick video on the three ratios that lenders use when deciding whether or not to approve your mortgage. So before we get in this video, I'd really appreciate it if you could like, subscribe, share this video with a friend or a family member. It will really help my channel grow and reach more Canadians who are looking to learn about the mortgage and real estate industry. So the first ratio that lenders are going to take a look at is the loan to value, or the LTV. So the LTV is determined by dividing your mortgage amount by the property value. So when purchasing a home, the loan to value is determined by your down payment. So for example, let's say you're purchasing a home for $500,000 and you put a $100,000 down payment. That loan to value is going to be 80%. So the loan to value is an important ratio because it determines the risk that the lenders have in this property. The greater the loan to value is, the more money they have invested, the more skin in the game they have. The lower the loan to value is, it means that you have more equity built up in the home, so overall it's less risky for the lender. So the reason why the loan to value equates to the level of risk for the lender is because let's say you did default on your mortgage and the lender now has to start the power of sale process to try and recoup their funds. The lower the loan to value means the less money they have in the property. So there's less money they have to get back to break even. Whereas if there's a higher loan to value, that means more money that they have to get back from the power of sale. When purchasing a home, the maximum loan to value a lender will go up to is 95%, meaning a 5% down payment. So for example, if you were purchasing a $500,000 home, the minimum down payment would be $25,000. So your mortgage amount would be $475,000. So that is 95 loan to value. When you're refinancing your home, the maximum loan to value is 80%. So let's say that $500,000 home, 80% of that is $400,000. So the maximum mortgage amount, new mortgage amount you'd be able to take out on a home from a refinance would be $400,000. The next two ratios I'm going to be talking about are income ratios, and lenders use these ratios to verify that you'll actually be able to afford the mortgage payments. So that's gross debt servicing ratio and total debt servicing ratio. These two ratios compare your monthly income to your monthly debts. So first I'll talk about the GDS, or gross debt service ratio. So GDS takes your monthly expense obligation from purchasing this home and divides it by your monthly income. Generally, lenders want to make sure that this new expense obligation coming from this property doesn't take up more than 39% of the gross income on the application. So TDS takes into consideration the same thing as GDS, but on top of that, it also adds in other monthly debt obligations you have. So credit card bills, student loans, auto loans, personal loans, and this also divides that by your monthly income. So typically lenders want to verify that the expense from this house plus your other monthly debt obligations don't take up more than 44% of your monthly gross income on the application. So in order to get these ratios in line, you pretty much have to widen the gap between the amount of income you make versus your debt obligation. So there's a couple of ways to get these ratios in line. If you're looking at from the income perspective, you can, if you got a raise, that help. If you worked some overtime to increase that income, keep in mind where any overtime hours would have to be used as to your average. Or if you were to add a cosigner to your application, that also help increase your income if that cosigner did bring a solid income to the table. Or if you were looking at from the debt side of things, you could pay off debts from proceeds. If you were refinancing your home, you could increase your down payment, which would lower that mortgage amount. Or you could also get access to a better rate, which would also help get those ratios in line. So I hope this helped you get a better understanding of what lenders are looking at when they're looking at your application. If it did help, please like, subscribe, comment, and share with a friend, as that will help my channel grow. I've also created 3 guides to help anyone who wants to get them. They're free. The first guide is a first-time homebuyer guide, and this just goes over if you're a first-time homebuyer and you're just thinking of buying a house, it's on the back of your mind. It's just gonna kind of lay out the steps, what you should do to prepare, what you shouldn't do, and it'll give you a checklist at the end of that. And I have a refinance guide if you're looking to refinance, and then I also have you got your offer accepted, now you need to obtain financing. So if you're interested, check out those 3 guides. I'm gonna link them below in the description. If you have any questions, comment them in the comments and I'll answer them. Maybe I'll even answer them with a video. Or if you want, I'm linking my calendar link down below as well. So you can click that link and book in a time slot to have a little convo with me.